Good afternoon. It's Jeff Christian from CPM Group. It's Friday, the 26th of February, the last trading day of February. We've made it through 2 months of 2021 so far, hobbling into town without brakes complaining. I was going to talk about a variety of different things today, but what we've seen today is a rout across commodities. Gold is off more than $50, platinum is off, palladium, silver, but it's also wheat, corn, copper, oil. It's a sharp decline, 1-3% decline in commodity prices across the board. You've also seen some weakness in the equities markets. So that tells you it's something general. And what it is there is an upward blip, a bigger upward blip in Treasury bond yields. Now, I think they're probably on a nominal basis about 1.5, and on a real basis, they're probably around negative 0.5. So we saw another increase in interest rates, and that has really hit the commodities markets. There were other things going on. So, for example, today's the first delivery day for palladium on the NYMEX and silver on the COMEX, and that had a price weakening effect, which we'll get back to perhaps toward the end of this conversation. But there were some other things that were going on, but it's really the interest rates that have been driving this, and that's what it is. And we've had these discussions repeatedly over the last week or so because you had seen like a 30 bip increase in T-bond rates, and it seemed to have what a lot of people thought was an undue effect on gold prices and other commodity prices earlier in the year. And so we've been explaining that there's like really two markets. And the one is a longer term market that says, look, interest rates are extremely low, record low. They're coming off of record low levels, and they've only risen slightly off of those record low levels. It doesn't make sense that there should be such a negative reaction in the commodities prices to such a small move at a low level. And from that perspective, they're completely right. But there's a whole nother category of investors and speculators and traders who use valuation models for trading not only commodities, but currencies and other debt instruments and equities. And it's cued off of the T-bills and the T-bond markets. And any little increase or decrease in the T-bond rate causes the valuation of other assets to change. So if the T-bill rate moves up even a little, the computers will say, okay, if interest rates are that much higher, the prices of stocks and corporate debt and oil and gold have to be lower in order for the potential return of them to be competitive with interest rates. And it's a very short-term thing. It's a short-term effect, but it's very important on the short term. And we're seeing that sort of right now. So you really have an interest rate driven reaction in commodities. The dollar was up strongly. Other assets, commodities were off. And that's what we've really seen. Now, our expectation had been for slightly stronger gold prices in the first quarter than we've seen. Well, we started off the year very, very strong, and the gold price rose very sharply in the first couple trading days, but then it's come off ever since that time. Our expectation had been that gold prices would kind of move sideways. I mean, on an annual average basis, we're looking for a 6% increase in gold prices this year over last year. But that's because in the first half of 2020, the gold price was significantly lower. We're actually, if you look at the second half of 2020 gold prices and you compare them to our expectations for the first 3 quarters of 2021, it's pretty flat. We're kind of expecting the gold price to run flat to slightly lower in the second and third quarters, and then start to pick up in the fourth quarter. And that has to do with a bunch of things. There's seasonality that kicks in. Seasonally, gold prices and silver prices tend to be strongest in the first and fourth quarters and weakest in the second and third quarters. So we had expected that if the seasonality was there, that would count. In addition to that, we had expected a lot of irrational exuberance in the first quarter. The vaccines were out. We had, we're conquering the pandemic. The economy is on the recovery. We have a change of government that like it or leave it, it's going to be more rational and less abusive and abrasive, both in terms of domestic policies and in terms of international affairs. So there was we expected some optimism in the first quarter, which would weigh on gold and silver as portfolio diversifiers. And then we thought that as the year progressed, a certain realism, if not fatalism, would set in. And they say, oh, wow, we've got the vaccines, and the vaccines are very slow to distribute, and it takes months to get there, and it's going to be the third quarter, if we're lucky, before we have a sufficiently broad enough vaccinated public in the United States and Europe to make a difference. And it's going to be 2022 before we see that on a global basis, because the US and Europe are kind of hoarding the vaccine. I used the term bogarting it in an interview earlier today. And then the economy, okay, yeah, we're out of the recovery, but we've got all those problems that existed before 2020, and a lot of them have been compounded and accelerated and accentuated by the recession last year and the lockdown and the pandemic. So we thought there'd be a less euphoric view of economic prospects in the middle part of the year, and that would then contribute to a blasé commodities market in general. And then by the end of the year, some stronger growth. Yes, the vaccines start kicking in around the developed worlds, and maybe we start moving towards something more normal, not like it was, but something new that's a little bit healthier. So that was our expectation. It still is. As I said, the gold price is a little bit weaker than we had thought. We would not be surprised to see the price come down and test 1,700. We've been saying for several weeks now, when the price was 1,860, we said, look, we think that the price on a short-term basis, through our trade recommendations, the price could fall to, from 1,660 to 1,860 to 1,840, and then 1,820, and then 1,800. But each time we said that, we said ultimately we would not be surprised to see the price fall to 1,720 or even 1,700. There is support at 1,720 and 1,700. We saw it tested today. There's a little bit more support at 1,680. I wouldn't be surprised to see the price test those lows over the next 7 months. But I don't think it stays there, because those economic and political issues are still there, and they've gotten larger over the last 18 months, and we've got to deal with them. So I think that any weakness in gold prices will be taken as a buying opportunity. I mentioned earlier, today is the first delivery day for NYMEX March palladium contract, actively traded, and the March COMEX silver contract. We have seen a lot of stuff said about silver by people who really don't understand commodity markets. They don't understand that in a futures market, there are people who are using the futures market to hedge their commercial positions. And the biggest hedgers are actually financial intermediaries, banks and dealers. Very few producers of metal actually hedge in the futures market. They will go to their financial intermediaries and do a principal to principal hedge. And then the financial intermediary turns around and hedges its exposure in the futures market. Also, on the investment side, there is a tremendous amount of liquidity, which helps the market work on a global basis. And that liquidity is provided by, some people call them speculators, I call them investors or short-term investors. People who don't want the commodity, they want exposure to the price of the commodity. So they will buy futures and options in the expectation that they can ride the commodity price higher or lower, but they have no intention and desire to buy that. And you'll find people who don't understand that, and they'll say, well, if the futures market didn't exist, the gold price would be much higher because people would have to buy the physical gold. And that may be true, but the reality is that most of the people who buy gold futures and go long gold futures would not buy physical gold, because they don't want physical gold. They want exposure to rising gold prices, and they want it on a leveraged basis. And the idea of putting up 100% and buying gold and storing it and then taking it down to someplace and selling it when the price rises is not what they're interested in. They're interested in being able to buy gold price exposure on a leveraged basis and write it, and then with a phone call or now a computer click of a few keys, sell it and take their profits with a 10% or a 15% margin down. And that is very key. You know, we've seen a lot of bad comments, and unfortunately, a lot of these guys are so sure of themselves that they spout off and they tell other people that they don't know what they're talking about, only to find that the market goes in the opposite direction. And JP Morgan's still not bankrupt. In fact, it's probably having a bumper year because of the increased price volatility and the higher prices. So it happens. We will be doing our silver webinar and report next week, and it's an expanded report. We have had for 16 years a reception on opening Sunday night at the Prospectors and Developers Association of Canada big conference in Toronto. The conference is virtual this year, so we really can't rent a ballroom and give everybody canapes and drinks. So what we're going to be doing is a webinar on Thursday, March 4th at 11 a.m. Eastern time, and it's free and open to the public. They can go in and register, and we've made sure that thousands of people can attend if they want to. And we have a list of sponsors and distributors and media partners who are publicizing this around the world: China, India, Southeast Asia, North America, Europe. So we're having that next Wednesday, and we're going to be talking about it. In addition to that, we've in past years published a little book, which is sort of a preview of our Silver Yearbook. Our Silver Yearbook will come out in May this year. It usually comes out in April, but because of busyness on our calendars, we're coming out in May with our Silver Yearbook. And we have this little booklet that we've handed out at the PDAC, which is a preview of it. I mean, this is what we saw happening in the silver market in 2020, and this is what we think is going to happen in 2021. Since it's all virtual, this will be a PDF, ebook, and it'll be available on CPM Group's website, and it'll be available from the sponsors and distributors and media partners as well. And it's going to be expanded. There's a lot of things that have been happening in the silver market this year, a lot of things that have been said to be happening that haven't been happening. We've seen a massive increase in ETF holdings, many of which actually were bullion banks disgorging physical metal and replacing it with ETF shares, which kind of distorts it. And some people got very excited and said, oh my gosh, you know, investors bought 330 million ounces of silver through the ETFs. But in fact, investors may have bought a third of that or less. And a lot of that was silver being disgorged by bullion banks that had taken it on in 2018 and 2019 when investors didn't want it. And as you've seen, and it'll be in the report and it'll be in the webinar, silver inventories in London rose to a record 1.18 billion ounces by the end of 2019. They fell over the course of 2020 a little bit. They're still at very high record levels, near record levels, but you saw about 200 million ounces come out of the London reported bullion inventories of silver, and that was that disgorgement of unwanted silver from bullion banks that are pulling back from the market. And as some of those bullion banks pull back from the market, what you're seeing is a reduced liquidity. Depth and breadth of liquidity has contracted, and that causes greater friction in the prices and greater price volatility. So there's a lot of things happening in the silver market. There are a lot of things being said about silver that aren't happening, and all of that's going to be covered in the webinar next Thursday and in the report that will be released at the time of the webinar. So you're all welcome to go to CPM Group's website and find that invitation and register to do that. And we probably will be talking again before the 4th of March, or maybe we'll wait and do it on Friday the 5th. We've been getting a lot of positive reviews on these videos, and a lot of people like that they come out on Fridays, and then they watch them when they come out, and they review them over the weekend and think about it. that's all I have for now. Take care, stay clean, stay warm, stay dry, stay away from people who are coughing without a mask. And hopefully we'll see you next Friday. Thank you. Bye.